Today, we're going to pull back the curtain on a 400-year-old secret for, well, basically reading the market's mind. It's this amazing technique that helps you actually see fear and greed on a chart, giving you an edge that was first figured out by Japanese rice traders centuries and centuries ago. You know, this quote, it's as vivid as it is true for so many investors. It just perfectly captures that common and really painful trap we fall into. Taking those tiny profits way too early, eating like a bird, but then holding onto our losing stocks for way too long, letting them grow into these massive portfolio-crushing losses, booping like an elephant. It's a tough cycle. So why on earth does this happen? Well, it really all boils down to the fundamental investor's dilemma. It's this constant battle raging inside of us between our emotions and our reason. And let me tell you, it's an internal fight that can completely wreck even the most well-thought-out investment plan. And this slide, this is that internal tug-of-war, laid out perfectly. Fear just panics us into selling at the absolute bottom, right when prices are the lowest. Then greed comes along and yanks us in at the very top, when a rally looks like it'll never end. And oh, hope. Hope keeps us clinging to a losing trade, just praying for a turnaround that might never, ever come. In the end, these powerful emotions can just steamroll our rational judgment. But what if there was a way to kind of sidestep this whole emotional mess? Well, there is. And it's an ancient trading secret that comes from a really unexpected place: the bustling rice markets of 18th century Japan. Yeah, and this isn't some hot new trend, not at all. As you can see here, Japanese candlestick analysis was developed over centuries. It was refined way back in the 1700s by a legendary rice trader named Sokuta Homa. I mean, this guy became one of the most respected traders in all of Japan just by mastering these charts. And today, we're using the exact same core principles, just, supercharged with modern technology. And you got to think about it, right? A method for analyzing markets doesn't just stick around for 400 years by accident. Its long life is basically proof of its credibility. The reason it works is because it's based on the one thing in the markets that never, ever changes: human psychology. Okay, so how do we actually do this? How do we read these market emotions? Let's dive in and look at the mechanics of how these charts visualize that constant, epic battle between the buyers and the sellers. So each one of these little candles tells you a whole story of a single trading period. The wide part, we call that the body, and it shows you the range between where the price opened and where it closed. If the body is green or white, the price closed higher than it opened. That's a win for the buyers. If it's red or black, it closed lower, a win for the sellers. And those thin lines, the shadows, they show you the absolute highest and lowest prices hit during that time. So in just one glance, you see the entire day's battle. Now, a big, powerful trend rarely just stops on a dime and turns around. I want you to think of it like a massive locomotive barreling down the tracks. It can't just instantly go in reverse, right? It has to slow down first, hiss some steam, and you hear those brakes screeching before it can change direction. Well, candlestick signals are those warning signs. They're the screeching brakes, telling you that a trend is losing steam and might be about to change course. Let's look at a classic example here: the bullish engulfing pattern. It's seriously one of the most powerful and easy-to-spot signals out there, and it tells this really clear story of a potential trend reversal, from down to up. Okay, so here's how it plays out. On day one, the sellers are completely in charge. They're pushing the price down, and you get this solid red candle. But then, on day two, something really dramatic happens. Buyers step in with so much force that the green candle's body totally engulfs the entire body of the previous day's red candle. This is just such a powerful visual sign that the sentiment has completely shifted and the buyers have wrestled control away from the sellers. Now, the really great news is, you don't need to be analyzing these charts by hand on some ancient scroll like Sokuta Hanma did. We can actually combine this ancient art with modern science. Today's technology gives us this incredible edge, allowing us to confirm these visual signals with some really powerful analytical tools. One of these tools is called an oscillator, and the easiest way to think of it is like a speedometer for the market. It just moves back and forth to show you when a price move might be going too far too fast, either getting overbought on the high side or oversold on the low side. So a really popular oscillator is called stochastics, and you can think of it like a fuel gauge for a trend. When you see a bullish candlestick signal, like that engulfing pattern we just looked at, and at the same time the stochastics indicator is down in that oversold area, well, that adds a huge amount of probability that the signal is legit. It's like seeing the low fuel light flashing on the downtrend. And this is really how it all comes together in a simple discipline process. It's just 3 steps. First, you spot a powerful reversal signal on the chart. Second, you look for confirmation from an indicator like stochastics. And third, you manage the trade with a crystal clear entry and exit plan. It's all about combining that visual evidence with probability. Now, I know this might sound like a lot to learn, but here is the absolute best part. You do not need to memorize dozens and dozens of patterns. Seriously. Mastering just 10 of the most common and powerful signals is more than enough to find a steady stream of really high probability trading opportunities. Which, brings us right back to where we started. The real benefit of this whole approach isn't just about finding good trades. It's about mastering your own trading psychology. Here's a fundamental truth you just have to understand. In the short term, prices don't move because a company's earnings changed overnight. They move because of perception, because investor sentiment, what everyone feels about the stock, has shifted. And candlesticks, well, they are the language of that sentiment. So how do you get a truly unbiased opinion? Simple. You consult the market about the market. Instead of listening to all the news, all the talking heads, and everyone's opinions, you look at the price action itself. The charts are telling you directly what the sum of all market participants are thinking and doing right now. In this, right here, this is the final, crucial takeaway. A candlestick signal isn't just some random shape on a screen. It represents the combined knowledge, the beliefs, the hopes, and the fears of every single person who bought or sold during that period. It is the ultimate summary of all available information, all distilled into one powerful visual. So, I'll just leave you with this question to chew on. By learning to objectively read the emotions of the entire market, which are displayed so clearly through these 400-year-old signals, do you think you could finally gain the discipline you need to master your own?